in CapGen with a 6.7% consumer loan net charge-off. Since we last spoke in 2023, we've expanded our auto platform by stepping into the indirect auto space in 2024 after acquiring Foresight Capital, a near prime lender based out of Utah. We also had a small percent of indirect loans go into our ODAR 2025-1 deal. Another update is we've also applied for an ILC license in early 2025, and while we haven't gotten an answer yet, we are hopeful as we've gotten a few rounds of questions and follow-ups from them. And if we are successful, this would mean that we hold broker CDs, and this would allow us a path to being investment grade. And the last update is that we launched our Brightway card program in early 2021 and have been cautiously growing that given the current environment, and we now have over 800 million in credit card receivables on our balance sheet. To move on to our capital markets activities, in 2025, we issued about 6 billion in the public markets with great execution and expect to be just as active in 2026 with a mix between unsecured and secured bond issuances. While we do try to be a programmatic issuer, we like to have a 40-40 split between unsecured and secured in our secured program, with 20% of that floating. This just allows us to have significant flexibilities between both markets. For example, we recently relied more on the high yield markets, and which because they've been more fruitful. But in 2022, we relied on ABS markets more when high yield was a lot more expensive. Additionally, we also have 7.5 billion in committed bank lines among 15 different bank partners and maintain a healthy liquidity runway of 24 plus months, which also allow us to operate and grow even if capital markets to be completely shut down. On the ESG front, we have issued social bonds to credit at-risk communities in the public markets. Most recently, in August of 2024, we issued 7.5 million of unsecured bonds with net proceeds of the offering going to finance loans of individuals residing in credit unsecured communities as defined by the Federal Reserve. For our OneMain customers, we also offered TRIM, which is a tool that helps save our customers money with bill negotiation, subscription canceling, and other budgeting tools. We also have a financial education program called Creditworthy, which has provided over 4,700 high schools and 50,000 students nationwide with financial literacy. I know there was a question about Tricolor, so I'll touch on that briefly. So for Tricolor and First Brands, we think those are just isolated cases of fraud. And since we are a big company, we are able to invest in software such as ABS Suite, which allow us to automatically not be able to double pledge any loans. Additionally, we have a dedicated collateral team and have at least 2 people reviewing any collateral that is being pledged. I think that's it for the capital markets section. I'll hand it over to TJ, and then we're happy to take any questions.
Yeah, thanks, Bhavna. Just give a little bit of overview of kind of where we are from a credit perspective and what we're seeing, I think, credit performance-wise, and then I'll kind of step back and can talk through kind of where we are from like, if you want to call it credit posture or from a credit strategy, credit box perspective. So I think, as Bhavna said, speaking back to kind of where we were through Q3 25, we can't really talk to results all the way through 2025 yet as we're doing our earnings release, I think at the very end of this month or very beginning of February, I can't remember which. But from a credit performance perspective, we are seeing really positive trends on the credit net charge-offs. We're guiding this year, we guided to is a 7.5 to 7.8% net charge-off rate. That's total company, including all products. That's down from, we were in the low 8%, 8.1, 8.2% in 2024. So positive trends on the credit side. We signaled that at the beginning of the year. We had a range of 7.5 to 7.8% when we guided back in January of 2025. and we were able to narrow that range down towards the lower half of that range as we move through 2025. I think really seeing some of the fruits and benefits of some credit tightening that we were enacting probably as early as back as middle of 2022. We saw coming out of the pandemic, we saw some more stressed performance on early vintages that were booked in mid to late 2021 and early 22 in their early performance, which drove us to do some tightening, pretty significant credit tightening in the back half of 2022. And I would say, even as we were moving through 2023, when you looked at the sum of kind of the actions that takes place, obviously we're always constantly doing some refinements and tweaks on the edges of our credit box when we see certain segments not performing as we'd expect or performing worse than we'd expect. There's tightening we'll do, but I think we did a broad-based action in back half of 2022, and then I would say broadly in 2023 we were doing much more tightening actions than looking for areas to expand, even if they were lower risk areas. Which I think it's really the vintages and originations we've been booking for the past 2 to 3 years now, since late 2022. They have been performing in line with origination vintages that we booked in, say, 2017 and 2018. But I say, albeit under a much tighter credit box today and over the last 2 or 3 years than where we were back in 2017, 2018, 2019. So I think we're still seeing a challenged consumer from in this environment, like with this, you're going to call it the average incomes of $75,000, credit scores in the 600 to 660 range. The environment, I think, is still a challenged environment coming out of that inflationary period we experienced a couple years ago. So kind of on a like-for-like basis, same risk grade, same customer profile, we are still seeing some worsened performance relative to what we were seeing, say, 6 or 7 years ago. But through our credit actions and credit box and credit tightening, we're able to generate originations performance similar to pre-pandemic levels. But I think, like I said, we're seeing positive momentum there. The credit performance this year is going to be probably 50 to 75 basis points better than where we were in 2024. And seeing positive trends there. I think even just on the consumer loan basis, which would include kind of our personal loan and auto loan business, on a year-over-year basis in third quarter, we were down about 60 basis points on our net charge-offs reported. And then even on a delinquency basis, we were down 30-plus delinquency was down about 20 basis points year-over-year, and similar on the 90-plus basis being down about 15 basis points year-over-year. So obviously the 30-plus and 90-plus delinquency as of third quarter is kind of pretending to tell you where the future next couple quarters are going to go from a credit loss perspective on a year-over-year basis. So real positive trends there. I would say from a credit strategy perspective, kind of where we're sitting today, I would say over the last year or so, I would say we've been a little bit more, I think, neutral in terms of a credit stance. Like we're identifying areas of low risk opportunities where we can expand into, and we're always still continuing to refine on the edge of the credit box where we're seeing performance a little bit out of pattern. These are more like smaller drill down segments. Always innovating as well. We're in addition to just our internal proprietary like credit scores that use thousands of attributes, the most like on the leading edge of machine learning models that use just straight point in time credit bureau data. They use trended credit bureau data. They use alternative data that incorporates more things that you don't find on necessarily on the credit bureaus, like utilities, phone bill data, some of that we get our hands on that are all embedded in our underwriting models. I think a place where we found some real extra gains from a credit modeling perspective and risk differentiation has been looking at bank account data. So, and doing more of kind of a cash flow underwriting in addition to our credit models. We're able to get bank account data on about 40-ish% of the customers that we underwrite. And there's a big incremental lift on identifying both customers on the good and bad side when we're able to see what they do with their monthly checkings and savings accounts over the last year or so. So there's a lot of trended data we're able to get to add a lot of value. So that's kind of one of the big areas we've been focused on the last couple of years is not only developing this like scoring off of bank data, but also getting more coverage. And we were probably in the 20 to 30% range of coverage where we got bank account data, and it's now up to 40%. We're trying to make that interaction even cleaner to increase that even further because we do see a lot of value there. I think just looking through kind of some of the other things in the agenda from a competition and market perspective, I think we've seen ebbs and flows of, I would say, the competitive environment. I think back probably 2 or 3 years ago, the competitive environment back in like 2022 was as competitive as we've ever seen. I think as the rate environment changed and some of the funding opportunities for some lenders shifted back then, we saw that really open up and be for a year or two really positive competitive environment. I'd say our competition kind of exists in a couple different places. We're competing against kind of the other, I would say, regional-based personal lenders that are more branch-based. Think about like a Lendmark, a Mariner type, but we're also pretty heavily we're heavily in the channel where like the internet affiliate channels. So think like Credit Karma and LendingTree. So that's where it's a much more competitive kind of marketplace environment that we see. I would say more kind of like the fintechs coming kind of in and out more sporadically there. But I would say overall in the last year or so, the environment's still been pretty favorable for us from a competitive perspective. Demand has been still very strong. I'd say application demand year over year is been good and up on a year over year basis. I'd say we'll see where that still trends. Obviously, still working on where we think 2026 is going to go. A lot of moving pieces and what some of the say changes from tax refunds and some of the tax implications that we think could be beneficial for our customers. So it's something we're looking at from a credit perspective, but nothing we're building in as we kind of move forward to say, is this tax refund season going to be really good moving forward or not? But I think that probably hit on most of the things from like a credit competitive environment. So I'll kind of stop there. I know I said a lot.
TJ, thank you for that. I just wanted to understand how you're finding competition on lending rates. Is it that there's quite a lot of competition that's driving down kind of the rates you're charging to customers on a kind of risk-based approach?
I'd say that's where we like out on the space that I mentioned in terms of like Credit Karma and affiliate space. That's where we have to be most competitive with our pricing. I would say generally over the last probably year or two. So like we have more like preferred pricing for what we call kind of our affiliate prime segment, and think about that being our top risk grade and like a 640, 650 plus credit score. That's kind of where it's the most competitive. I would say in that space over the last year or so, we've been actually taking price up over the last year or so. So we've been able to take some back, which has been encouraging. I don't have like yield metrics right in front of me, but we've been able to improve our yields and net interest margins over the last year or so as well.
Thank you. And are there any areas in particular that you're kind of moving away from just because that return doesn't work on a risk basis?
I think nothing like general, like big segment, like nothing specific geography-wise or a big customer segment. I'd say we're always like refining and looking at more attributes, and if anything else, defining like a customer that's performing kind of not as we'd expect within our risk rating or our, if you want to call it our risk like quintiles of scores. But I'd say when we went back probably more like 2 to 3 years ago when we were really stepping into tightening, I think an area we found, a specific segment we found was kind of more, I would say, customers whose credit bureaus looked, I would say, more robust or more thick because of like credit builder type trades. So think about like Plaid or Chime accounts that were more operating as like secured accounts, but the trades came through on the credit bureau that made them look like more unsecured type of credit card type trades. We made some adjustments there to make a lot of tweaks and be able to identify those type of credit builder type trades on the accounts that we do treat those a little differently. I'd say that was a big one, I think, that we identified, but there's nothing like geography specific or like industry specific that we've been honing in on recently.
Thank you.
Yeah.
I was wondering if you could just touch as well on just the more secured area on backed by some of the vehicles, just in terms of your appetite and over your opinion on the used vehicle market as well.
Yeah. Obviously, the used vehicle prices have been pretty strong and remain pretty strong for a while now. I'd say we've been doing secured lending for a long time. I would say historically our secured lending was more requiring collateral for a customer that was applying for a loan because they didn't fit our criteria for like an unsecured loan from a credit perspective, so we would require collateral. And then we've also done historically, I would say, more existing autos that customers had outstanding debts on that we would kind of do more cash out refinancing type lending. And then the last few years, we've really moved in and built up our auto finance program, which is more auto financing at the point of purchase. Both from we were doing it kind of on a direct underwriting basis with a dealer relationship we organically built up to a portfolio of about $1 billion, and then like Bob mentioned earlier, the indirect auto portfolio purchase that we made back now, I guess, second quarter of 2024, which was about right around $1 billion as well. So we have about a little over, I would say, a couple $1 billion of outstanding loans that's auto financing at the point of purchase. That indirect auto lender kind of fit our profile from like a risk perspective and how they manage credit. We looked at a variety of different kind of, if you want to call it, indirect, non-prime to subprime auto lenders, and ended up obviously making the deal with Foresight. I'd say in general we're still pretty bullish on. We're very bullish on the auto financing auto finance portfolio as a diversification to our product suite. We had all the like back-end servicing in place from a remarketing and repossession perspective, as we've been doing that for a long time. I don't think there's any. I think we've seen used vehicles kind of stabilize. Used vehicle prices stabilize a lot over the last year or so. But I think obviously we've seen some challenges externally in that subprime auto finance space. But it's obviously we're going to apply our diligent credit approach, be ready to react if we're seeing anything within our book, and act quickly and make changes like we always have in the past.
Thank you.
I was just checking before I jumped over a couple of questions. If anyone else from the NatWest team had any questions? No, but I think I first just wanted to ask. I found it quite sort of interesting what you were saying about how you're starting to rely a lot more on a bank account data itself, and how you're sort of looking to grow the sort of percentage of customers in your underwriting that you have that information from. Is that sort of information that you sort of acquire from customers via sort of an automated platform, or is it very much that you're just relying on better engagement with your customers to get them sort of share that enhanced level of information? I'm just sort of interested to sort of see how that's
it's like it's kind of like a user interface like we would do, where you kind of go through Plaid and you have to take a couple steps to enter in bank account information, but it's, we've been trying to make that more and more seamless and an easier, less friction process for the customer as they're going through the application process. But yeah, it's an automated setup that when you're going through the origination process. But yeah, we do see heavy value in it. Obviously, it kind of makes sense, right? Like, you can get so much data from the credit bureau and credit history, but you're not totally aware of just what customers are doing from a bank account and bank balance. Are they bottoming out their bank balances every month? Are we seeing trending of bank balances going down? Like, you can do so much in terms of getting income verification and salary information, but truly seeing what's in their month-to-month cash flows is very powerful.
No, definitely agree. So it's a useful sort of metric to think about. And I think just the only other question I sort of had more as a curiosity, and I'm sure it's sort of been discussed a lot on your side, but we were looking at it on the desk here from the announcements over the weekend from Trump about the capping of credit card bills. I'm just wondering if you've had any views on that. Obviously, we've been talking about that a bit here.
It's a big one. I think it would have a major altering in the credit card industry in the U.S. for sure.
Exactly.
I'm sure there's a lot of things to think about in terms of what different fee structures we would try to put in to recoup revenue. I think there'd be these are all just my thoughts, but much less access to credit in the lower end of the credit spectrum, and less access to credit cards, and that would drive them to different alternative lending that's probably going to be even much more expensive than the rates that they had on their existing credit cards. I think there has to be a whole rethink of just not even regular super prime and prime, a rethink of the rewards programs that go along with credit cards. It's a massive shift. I'm just trying to see because a couple of the big banks released, I haven't been able to get in yet to see. I haven't seen anybody with any real big statements on.
No, I think we were sort of doing a similar thing here. I think a lot of I didn't really think many people have sort of given it that much attention, if I'm honest, but always just interesting to hear
I think
individuals' views.
I think there's a little bit of hesitancy to probably go public with some statements right now and get into any crosshairs too. So, but yeah, no, it's obviously it's a big change across everywhere. But I don't know how likely it is either, to be honest. But we'll see.
Exactly. Just early days.
Right. Who knows what could come up in the next couple of days?
Precisely. I'm not sure if any of our other NatWest colleagues had any other questions for TJ and the team whilst they're on.
Just a quick question on the bank license piece. So that there's been no further update to that process, I guess. I think the last update we had out was good feelings, but still going to be kind of top of the house political decision on
Yeah.
what comes next for the number. I think there's a few others besides yourselves who are pursuing that license, and it would be kind of like, it's going to get pushed from the same people talking about the credit card thing to get that over the line.
Yeah, we did. I do believe we were one of the first people that applied in 2025, but you're correct that we haven't really gotten a definitive answer yet, and we hope to get that soon, but we've gotten about a couple rounds of questions and follow-up, so that we're taking that as a good sign, because I understand that at times before they just haven't responded at all. Well, I'm not sure if there's any other questions, but even if there's follow-up, please feel free to reach out, and we'd be happy to get back to you guys. But I just wanted to take a moment and say thank you all for making it on the call today, and we really appreciate your partnership over the past few years, and we're really looking to continue forward as well. So, and thanks, Jim, for all the help on the renewal and Emotion as well.
But no, definitely thank you all for making the time. This was really helpful. I think just sort of one quick question whilst we're all on the line. I think sort of as a part of some of the previous renewals, we were able to sort of look at data for sort of the whole portfolio, just to sort of get the most up-to-date snapshot of sort of where you saw weighted average balance, weighted average FICO, and those types of metrics. Is there sort of a reporting as of, I think you mentioned your Q3 was the latest that you had, that you could sort of share with us or point us to where we could pull that information from? I think we're really just sort of looking for a most up-to-date sort of snapshot of the whole company portfolio, and just sort of to update our internal performance review that we have sort of for gross charge-offs, delinquencies, etc. Across the book.
Yeah, so for the most updated right now is on the 17G5 site, which is as of Q3. I think Q4 would be potentially rolling out, I want to say, sometime this month, and I can get back to you on the definitive timing. But all our earnings releases and then our investor presentations for the ABS side, they're all on our website as well, if they are useful. But I would definitely say that whatever we have on the 17G5 is the most latest on portfolio data.
But no, that's helpful. I think we'll take a quick look there and see if we can sort of put everything there. If there's any gaps, I'll drop you a line.
Yeah, that works.
Perfect. Thank you.
Right, well,
Yeah, thank you everyone so much for taking the time. We'll drop a follow-up email if there's anything else we need for our credit work.
Thanks, guys.
Thank you.
Thank you very much for your time.
Thank you.
Cheers.
See ya.